In today's video, I'm going to test an RSI, MACD, and stochastic trading strategy to see how well it performs. We'll code the entire strategy in Python, optimize it using Freqtrade, and run backtests to evaluate its effectiveness. So, let's dive right in. To begin, let's quickly go over the key indicators we'll be using in this strategy. 1. MACD, Moving Average Convergence Divergence. The MACD is a popular momentum indicator that helps us track price trends and momentum shifts. It's calculated by subtracting the 26-period exponential moving average, EMA, from the 12-period EMA. The result is the MACD line. Additionally, a signal line, which is the 9-period EMA of the MACD, is used to generate buy or sell signals. When the MACD line crosses above the signal line, it's considered a bullish signal, and when it crosses below, it's bearish. 2. RSI, Relative Strength Index, one of the most popular tools in technical analysis. Now, RSI measures the speed and change of price movements, with values ranging from 0 to 100. But instead of using the typical overbought above 70 or oversold below 30 thresholds, today we're focusing on the 50 level as a key signal. When RSI crosses above 50, this is a sign of bullish momentum. It shows the market could be picking up strength for an upward trend, possibly a buy signal or an indication that prices are likely to keep rising. On the flip side, when RSI crosses below 50, this indicates bearish momentum. It suggests the trend might be losing steam or turning downward, potentially a sell signal or a warning of further declines. 3. Stochastic Oscillator. The stochastic oscillator is all about comparing a security's closing price to its price range over a specific period. It moves on a scale from 0 to 100. And here's what you need to know. When the value is above 80, this is considered overbought, meaning the price may be due for a pullback or reversal, possibly a signal to sell. When the value drops below 20, this is considered oversold, meaning the price might be undervalued and could start trending upwards, potentially a buy signal. All right, now that we understand these indicators, let's talk about combining them in our trading strategy. We can't rely on just one technical indicator, as it often leads to false signals. By using multiple indicators together, we can confirm the reliability of our analysis and make better trading decisions. All right, let's dive into what needs to happen when we're taking a long position. First, we're looking for the stochastic oscillator to drop into the oversold zone below 20 and then climb back above 20. This gives us a signal that the price could be reversing upward. But remember, it shouldn't climb too high into the overbought zone, above 70. Next, we check the RSI. It needs to cross above 50, which shows that the buying momentum is starting to pick up. Finally, we turn to the MACD. We need a bullish crossover, where the MACD line, that's the blue one, crosses above the signal line, the orange one. This confirms our upward momentum. Once all three of these conditions are in place, we take a long position on that candlestick. To manage our risk, we'll set a stop loss using the ATR indicator and aim for a take profit with a solid risk-to-reward ratio of 2. And here's a perfect example. Look at this trade. The price reached our take profit target just as we planned. Now let's flip things around and talk about short positions. Here's what we need to see before entering a short trade. The stochastic oscillator must rise into the overbought zone, above 80, and then fall back below 80. This indicates a potential downward reversal. Just make sure it doesn't drop too low into the oversold zone, below 20. Next, we turn to the RSI. This time, it must cross below 50, signaling that the selling momentum is picking up. Finally, we check for a bearish crossover on the MACD. That's when the MACD line, the blue one, crosses below the signal line, the orange one, confirming the downward trend. Once all three conditions are satisfied, we take a short position on the following candlestick. Then, we manage risk by setting a stop loss using the ATR indicator and aim for a take profit with a 2-to-1 risk-to-reward ratio. And just like that, here's an example of a successful short trade. The price hit our take profit target. Now that we've gone over the strategy, let's talk about how to optimize it for maximum performance. To do this, we'll be using Freqtrade, a powerful open-source cryptocurrency algorithmic trading software developed in Python. If you're interested in learning more, check out the full Freqtrade tutorial, linked in the description below. It covers everything you need to get started. Instead of optimizing once and hoping for the best, we rely on walk-forward analysis. This approach lets us continuously test the strategy on fresh, unseen market data as it evolves. By doing so, the strategy adapts over time, producing more reliable results and reducing the risk of overfitting. Next, we optimize several key parameters to refine the strategy: stochastic thresholds for oversold and overbought levels, stochastic rolling window. Since it's rare for all three signals to align on the same candlestick, we use a rolling window to capture signals that occurred a few candlesticks ago, whether oversold or overbought. RSI and MACD rolling window. These rolling windows work the same way as the stochastic rolling window. If a valid signal condition happened within a defined range of previous candles, it's considered actionable. This increases the likelihood of catching opportunities. RSI threshold, to identify the best entry point. ATR multiplier and risk ratio. These are used to set effective stop-loss and take-profit levels. By carefully adjusting these parameters, we're able to refine the strategy and ensure it delivers consistent, reliable results. Now let's look at the results. The strategy was tested on SOL perpetual futures, over 13 months of out-of-sample data. It delivered a 121% cumulative return, with a maximum drawdown of just 15%. Monthly returns ranged from -15% to +29%, and it remained profitable in 9 out of 13 months, showing strong and consistent performance. It executed an average of 4.6 trades per month, which means the strategy stays selective, avoids overtrading. The maximum losing streak was just 1 month, highlighting its ability to avoid extended periods of underperformance. On TON perpetual futures, the strategy showed 85% cumulative returns against a 23% maximum drawdown. Of course, backtest results don't guarantee future performance. If you want to explore this strategy further, we've made it accessible with full code, along with a complete Freqtrade and walk-forward analysis course that guides you through every step. I've left the link in the description below. If you found this video helpful, make sure to subscribe, hit the notification bell, and share it with anyone interested in quantitative trading.